Normally I can help with things like this, but I don't seem to have access to that content. You can try again or ask me for something else. Let's cut through the noise immediately. You might have the best trading strategy in the world, you might have an algorithm that predicts market movements with uncanny accuracy, and you might have the discipline of a Shaolin monk. But if you are executing those trades on a platform that is fundamentally working against you, or worse, is structurally unsound, none of that matters. You are building a skyscraper on quicksand. This is where we separate the casual hobbyists from the serious market participants. We are not just looking for a platform that looks pretty. We are conducting a forensic audit of the infrastructure that holds your capital. The first and most critical feature set we must analyze is the regulatory environment and the safety mechanisms embedded in the platform's corporate structure. This is not the exciting part where we talk about flashing lights and chart indicators, but this is the part that determines whether you actually get to keep your money if you manage to make a profit. In the United States, the regulatory landscape is incredibly strict, primarily governed by the National Futures Association, the NFA, and the Commodity Futures Trading Commission, the CFTC. If you are a U.S. resident, your platform options are limited by design to protect you from the excessive leverage that destroys retail accounts in other jurisdictions. However, the internet is global, and many of you watching this might be tempted by flashy banner ads promising 1 to 500 leverage or zero spreads from brokers located on island nations you would struggle to find on a map. This is where the tier system of regulation becomes your first filter. When comparing platforms, you must look for Tier 1 regulation. We are talking about the NFA in the US, the FCA in the UK, or ASIC in Australia. These bodies do not just hand out licenses for a fee. They enforce strict capital requirements. They demand that the broker holds millions of dollars in operating capital to ensure liquidity. Imagine this scenario. It is a volatile Tuesday morning. The Federal Reserve announces an unexpected interest rate hike. The US dollar spikes. Everyone is rushing to the exit. If your platform is regulated by a Tier 3 authority in an offshore jurisdiction, their liquidity providers might dry up. The platform freezes. You try to close your position, but the sell button is grayed out. You watch your screen as your account balance drains to zero, and then terrifyingly into the negative. By the time the platform comes back online, the quote is miles away from where you wanted to exit. This is not a glitch. This is often a feature of poorly regulated platforms that lack the Tier 1 liquidity bridges required by top-level regulators. This leads us directly to the second non-negotiable feature you must verify: segregated client funds. This sounds like legal jargon, but let's break down exactly what this means with a practical example. When you deposit $10,000 into a trading platform, where does that money go? In a commingled account, your money goes into the same pot as the company's operating expenses. This means the broker could theoretically use your $10,000 to pay their electricity bill, their marketing budget, or the CEO's bonus. If that company goes bankrupt, your money is treated as a company asset, and creditors can seize it. You stand in line with everyone else hoping to get pennies on the dollar. In contrast, a platform offering segregated client funds is required to keep your money in a completely separate bank account, often with a top-tier custodian bank. The broker cannot touch it for their own expenses. If the broker goes insolvent tomorrow, your funds are theoretically sitting in a separate vault identified as yours and can be returned to you. When you are looking at a platform's About Us or legal page, do not just look for the claim. Look for the name of the custodian bank. If they are vague about where the money is held, that is a red flag the size of a billboard. Now, let's discuss a feature that saved thousands of traders from financial ruin in 2015: negative balance protection. To understand why this is a must-have feature, we have to look at a historical case study that shook the Forex world to its core: the Swiss franc Black Swan event of January 15, 2015. For years, the Swiss National Bank had pegged the franc to the euro. Traders viewed this as a stable, predictable market. People were leveraged to the hilt, betting that the peg would hold. Suddenly, without warning, the central bank removed the peg. In seconds, literally seconds, the franc soared in value. The euro to Swiss franc pair crashed. The market moved thousands of pips in a blink. Liquidity vanished. There was no one on the other side of the trade to buy. Traders who had stop losses set found that their stops were triggered not at their safety price, but hundreds of pips lower. This is called slippage, which we will dive deeper into later. But the consequence was that traders didn't just lose their account balance. They ended up owing the broker money. Imagine waking up to find that not only is your $5,000 account gone, But you also owe the broker an additional $20,000 because the trade couldn't close until the price had plummeted that far. In the aftermath, some brokers pursued their clients for these debts, taking them to court and seizing assets. However, platforms that offered negative balance protection absorbed these losses. This feature guarantees that you can never lose more than you deposit. It acts as an absolute circuit breaker. When you are comparing platforms, specifically search their terms of service for this exact phrase: negative balance protection. If they do not offer it, you are accepting unlimited liability for a market event you cannot predict. Let's move to the technological infrastructure regarding execution policy. This is a feature often hidden in the fine print, but it defines the identity of the platform. Is the platform a dealing desk, market maker, or an ECN/STP, electronic communication network / straight-through processing? Here is the imagine-if scenario for this dynamic. You are trading on a dealing desk platform. You see a perfect setup to buy the euro. You click buy. The broker takes the other side of your trade. If you win, the broker loses. If you lose, the broker wins. There is an inherent conflict of interest here. Now, many reputable market makers operate fairly, but the incentive structure is tilted. In a dealing desk environment, the broker is essentially the casino. They set the price and they decide when to execute. On the other hand, an ECN platform connects you directly to the interbank market, to the big banks like JP Morgan, Deutsche Bank, and Citi. The ECN broker charges you a commission per trade, but they want you to win because the more you trade, the more commission they make. Their interests align with yours. When comparing features, look for DMA, direct market access. This ensures that when you click buy, your order is routed to a liquidity provider, not held internally by a broker who might be betting on your failure. We also need to scrutinize the platform uptime and server location metrics. In high-frequency trading or even day trading, milliseconds matter. This is known as latency. If you are sitting in New York, but your broker's server is in a basement in Cyprus, the time it takes for your click to reach the server and get a confirmation could be 200 milliseconds. In a fast-moving news event like a non-farm payroll release, price can move 20 pips in that time. You click at one price but you get filled at a worse price. Top-tier platforms will be transparent about their server locations. They often have data centers in major financial hubs like LD4, London, or New York 4, New York. They might even offer VPS, virtual private server, hosting for free if you maintain a certain balance, allowing your automated strategies to run directly on a server next to the exchange, reducing latency to virtually zero. If a platform does not boast about its execution speed and server infrastructure, it is usually because they have nothing to boast about. We have covered the safety net, regulation, segregation of funds, negative balance protection, and the broker model. These are the shields that protect you. But what about the sword? What about the tools you need to actually analyze the market and execute the attack? Most beginners look at a platform and think, oh, the charts look nice. But professional analysis requires specific, customizable data feeds and charting capabilities that 90% of retail platforms fail to deliver effectively. You might think you are seeing the real market price on your screen, but are you? Or are you seeing a smoothed-out, delayed feed designed to look pretty rather than accurate? There is a massive difference between an indicative feed and an executable feed, and the difference between them is usually where the profit margin for the broker and the loss for you is hidden. This brings us to the edge of a very deep rabbit hole. We have secured the perimeter, but now we need to talk about the cost of doing business. You have likely seen ads screaming, zero commission trading. It sounds fantastic, doesn't it? Why pay a fee if you don't have to? But in the world of finance, if you aren't paying for the product, you are the product. The costs are never zero. They are just hiding in plain sight, camouflaged inside the spread. In the next part of this masterclass, we are going to expose the mathematics of spreads versus commissions. I am going to show you a side-by-side calculation of how a zero-commission broker actually drains your account faster than a commission-based one, and we will reveal the dark art of spread widening during news events. You think you're paying zero? You might be paying double. You can't afford to miss this breakdown. Let's dismantle the zero-commission myth right now. It is arguably the most successful marketing sleight of hand in the history of retail finance. When a broker tells you they charge zero commission, what they are actually saying is that they have baked their fee into the price of the asset itself. They are not a charity. They are a business with massive overheads, compliance costs, and server fees. If you aren't seeing a line item for commission on your trade receipt, you are paying it in the spread, and historically, This method is vastly more expensive for the trader. To understand this, we have to look at the anatomy of a price quote. Every currency pair has two prices, the bid and the ask. The bid is the highest price the market is willing to pay you for your currency, and the ask is the lowest price at which the market is willing to sell it to you. The difference between these two numbers is the spread. In a raw interbank environment, the place where banks trade with other banks, that spread is razor thin. On the euro to US dollar pair, arguably the most liquid market in the world, the raw spread fluctuates around 0.1 to 0.2 pips. Sometimes it is literally zero. Now let's look at the zero commission broker. They take that raw market feed, and they artificially widen the gap. Instead of a 0.1 pip spread, they might offer you a fixed or variable spread of 1.5 or 2.0 pips. You might think, what's the big deal? It's just a pip or two. This mindset is exactly what the broker is banking on. Let's run the math on a standard transaction to show you how much this apathy is costing you. Imagine you are trading one standard lot of euro to US dollar. A standard lot is 100,000 units of currency. In this scenario, a 1 pip movement equals $10. Scenario A. You are on a zero commission platform with a 2.0 pip spread. You enter the trade. Immediately, you are down 2.0 pips because you bought at the higher ask price and the current market value is the lower bid price. That is an instant cost of $20. You have to make $20 of profit just to break even. Scenario B. You are on a raw spread or ECN platform. They charge you a commission, usually around $7 per round turn, opening and closing the trade, for a standard lot. The spread they give you is the raw market spread. Let's average it at 0.2 pips. When you open the trade, you are down the spread cost. 0.2 pips x $10 equals $2, plus the commission $7. Total cost, $9. Compare them. Scenario A cost you $20. Scenario B cost you $9. By choosing the free broker, you effectively paid a markup of over 100%. Now multiply that by 500 trades a year. That is a difference of thousands of dollars in pure unnecessary drag on your portfolio. It is the difference between a profitable year and a losing one. Over a 10-year career, the compounding effect of that wasted capital is astronomical. You are essentially paying luxury tax on a commodity product. But the cost of the spread is not just about the entry fee. It is about the spread widening phenomenon, a trap that catches even experienced traders off guard. This usually happens during rollover or major news events. Rollover is the period, usually around 5 p.m. New York time, when the banking day resets. Liquidity providers, the big banks, pull their orders to settle accounts for the day. For a few minutes, the market is thin. During this time, a zero commission broker with variable spreads might widen that spread from 2 pips to 20 pips or more. Let's play out an imagine if scenario that happens every single day. You are holding a short position on pound sterling to Japanese yen. You have a stop loss set perfectly above a resistance level, giving your trade room to breathe. The market price is nowhere near your stop loss. It is 5 p.m. The charts show the price is stable. Suddenly, your trade closes. You check the chart. Price never touched your line. You feel cheated. You call support. Here is what happened. The ask price, which is rarely shown on the default chart view, skyrocketed because the spread widened. Since you were short, you cover your position at the ask price. The massive spread expansion triggered your stop loss, taking you out of the trade at the worst possible price, even though the bid price, what you see on the candle graph, remained stable. This is not a conspiracy. It is a mechanical function of liquidity, but market maker brokers often exploit this by widening spreads far more aggressively than the underlying market dictates to clear out client stops. When comparing platforms, you must look for a tick history or tick data feature. A transparent platform will allow you to download the tick-by-tick data of both the bid and the ask price for any given moment in time. If a platform does not offer this transparency, asking them to prove why your stop was hit is like asking a casino to show you the algorithm behind the slot machine. They simply won't do it. Now we need to discuss the swap or rollover rate. This is the third hidden cost. In Forex, when you hold a position overnight, you are essentially borrowing one currency to buy another. You either pay interest or earn interest based on the central bank rates of the two countries. If you are buying a currency with a high interest rate against a currency with a low interest rate, you should logically be paid interest. This is known as a positive swap. However, many retail platforms treat swaps as a revenue stream. Let's say the interbank market rate dictates that you should be paid $5 a night for holding that trade. A greedy platform might mark that down and pay you only $1, pocketing the $4 difference. Conversely, if you are supposed to pay $5, they might charge you $10. I want you to conduct a swap audit before you sign up. Go to the platform's website and find their contract specifications or product schedule. Look at the swap long and swap short values for a major pair like euro to US dollar. Then, compare those numbers with a reputable industry benchmark or a dedicated swap comparison site. You will be shocked to find that some platforms are charging triple the industry average for holding positions. If you are a swing trader or a position trader who holds trades for weeks, this death by 1,000 cuts will bleed your account dry regardless of how good your strategy is. Furthermore, pay attention to Triple Swap Wednesday. In the Forex market, spot trades settle in 2 days, T+2. If you hold a position past 5 p.m. on Wednesday, the trade settles on the weekend. Since banks are closed on weekends, you are charged swap for Saturday and Sunday on Wednesday night. This means you get hit with 3 times the daily swap fee in one shot. Predatory brokers often inflate the Wednesday swap rates even further, knowing that amateur traders are not paying attention to the calendar. A professional platform will clearly display the swap schedule and the exact rates in the trade terminal window before you execute the trade. We have covered the entry costs, spreads, and the holding costs, swaps. But there is a ghost in the machine, a hidden hand that reaches into your account and steals pips right at the moment of execution. It is called slippage, and it is the silent killer of profitability. You see a price of 1.0500. You click buy. The platform confirms your buy. But at 1.0505, you just lost 5 pips instantly. Was it market volatility? Or was it a virtual dealer plugin designed to delay your order just long enough to grab a worse price? Most people think slippage is just bad luck. In the next part of this deep dive, we are going to prove that slippage is often a choice made by the broker. We will uncover the technology behind requotes and asymmetric slippage, where the broker passes on the bad prices to you, but keeps the better prices for themselves. This is the technical forensic analysis that brokers pray you never understand. Slippage, in its purest form, is simply the difference between the expected price of a trade and the price at which the trade is actually executed. In a fair and functioning market, slippage should be random. It should look like a bell curve. Sometimes market volatility works against you, and you get filled a pip or 2 worse than you wanted. This is negative slippage. But statistically, just as often, market volatility should work in your favor. If you click to buy, and the price suddenly drops before the order hits the server, you should get filled at that lower, better price. This is called positive slippage or price improvement. Now let's look at the forensic evidence of asymmetric slippage. This is where the bell curve gets mutilated. In this scenario, the broker, specifically a dealing desk broker operating an aggressive risk management model, configures their execution engine to pass on all the negative slippage to you, but they cap or retain the positive slippage for themselves. Imagine you place a limit order to buy the pound sterling to US dollar at 1.2500. You are telling the market, I want to buy here or at a better price. Suddenly, a geopolitical headline hits the wires. The pound drops like a stone. It gaps right through your level, and the first available liquidity is actually at 1.2490, 10 pips better than your entry price. In an honest ECN environment, your order should be filled at 1.2490. You start the trade with an immediate 10 pip profit effectively locked in relative to your plan. But with asymmetric slippage, the broker's system recognizes the discrepancy. It fills you at your requested 1.2500, and the broker pockets the 10 pip difference. They bought it from the market at 1.2490 and sold it to you at 1.2500 instantly. They made a risk-free arbitrage profit using your order flow. Conversely, if the price had gapped up to 1.2510 worse for you, they would have filled you at 1.2510, forcing you to eat the loss. Heads they win, tails you lose. When comparing platforms, you must dig into their order execution policy document. It is a tedious PDF that nobody reads, which is exactly why you must read it. You are looking for a specific clause regarding price improvement. If the policy states that limit orders are filled at requested price or worse, run away. You want to see explicit language stating that orders are filled at the next available market price, which implies that if the market moves in your favor, you get the benefit. This leads us to the archaic and infuriating mechanic known as the requote. If you have been trading for any length of time, You have likely stared at the requote pop-up window with a mix of confusion and rage. This usually happens during instant execution. You see the price is moving fast. You click buy. The platform pauses for 3 seconds, an eternity in high-frequency trading, and then pops up a message. The price has changed. Do you want to buy at? While you are deciding, the price moves again. You click yes. Another pause. Another requote. By the time you actually get into the trade, the move is over. You have bought the top. Here is what is happening behind the curtain. In an instant execution model, the broker is promising to fill you at the exact price you see on the screen. But if the market moves too fast, the broker cannot hedge that trade instantly in the real market without taking a loss. So they reject your order. They are protecting their own risk at the expense of your opportunity. Compare this to market execution. In a market execution model, which is a non-negotiable feature for serious traders, you are telling the broker, "Get me in right now at the best available price, whatever it is." There are no requotes. You might experience slippage, yes, but you get into the trade. Speed is prioritized over price precision. For any strategy that relies on momentum, news trading, or scalping, you strictly need a platform that offers market execution. If a platform only offers instant execution, they are effectively telling you that they are not equipped to handle volatile market conditions, which is ironically when the most profit is usually made. We must also address the technology of last look. This is a practice used by liquidity providers and some brokers where they get a free option to reject your order. When you send an order, they have a few hundred milliseconds to look at it and decide if they want to take the other side. If the market moves against them in that split second, they reject the order. If the market moves in their favor, they accept it. It is like placing a bet on a horse race after the horses have already left the gate. While last look is standard in some institutional settings, abusive application of it at the retail level creates a phantom liquidity environment where the prices you see on the screen aren't actually real. So, how do you detect if a platform is using software plugins to artificially disadvantage you? This is difficult to prove without an audit, but there are behavioral tells you can look for. One common historical issue that regulatory bodies have cracked down on is the virtual dealer plugin. This is a piece of software installed on the broker's server that introduces an artificial delay, let's say 1 to 3 seconds, specifically on client accounts that are flagged as profitable. If you are losing money, your execution is instant. The broker wants your losing trades on the books immediately. But the moment you start winning consistently, you might notice that your execution time starts to lag. That 3-second delay allows the broker's algorithm to check if the trade is likely to be profitable in the immediate short term. If it is, the plugin induces slippage or a requote. If you notice that your demo account executes instantly, but your live account lags, or that your execution speed deteriorates after a winning streak, this is a massive red flag. You should document these timestamps and compare them with other traders on different networks. To protect yourself, you need to look for platforms that provide post-trade transparency. Some advanced ECN platforms allow you to see the fix ID or the specific execution tag from the liquidity provider. This effectively gives you a receipt showing exactly which bank took the other side of your trade and at what precise microsecond. If a broker can provide you with a fixed stamp on every trade, they are likely running a legitimate pass-through operation. If they treat execution data as a state secret, proceed with extreme caution. We have dissected the financial engineering and the execution mechanics. Now we have to talk about the interface itself, the cockpit from which you fly the plane. You might assume that all trading software is created equal, or that charts are just charts. This is a dangerous oversimplification. The platform software you choose dictates the tools you have at your disposal, the programmability of your strategy, and crucially, who actually owns your data. There is a war going on in the industry between the legacy giants like MetaTrader 4 and 5, and the modern challengers like CTrader and TradingView. Most brokers will push you toward their own proprietary web trader. They will tell you it is user-friendly. They will tell you it is simple. Here is the truth about proprietary web traders. They are designed to keep you trapped. If you spend 2 years learning a specific broker's proprietary interface, building your watch list there, and getting used to their specific quirks, you cannot leave. The switching cost becomes too high. You are held hostage by the interface. If they raise their spreads, you stay because you don't want to lose your setup. Furthermore, proprietary platforms often lack the advanced analytical tools necessary for professional forecasting. They usually strip down the indicators to the basics, moving averages, RSI, MACD, and remove the ability to use custom scripts or automated trading bots. They want you to trade manually, emotionally, and simply. In the next part, we are going to pit the industry standards against each other. We will dive deep into the MetaTrader versus CTrader versus TradingView debate. I am going to explain why using a platform that supports automated scripts and backtesting is critical even if you never plan to write a single line of code. We will uncover why the portability of your trading history is a feature you didn't know you needed until it was too late. This is about taking ownership of your intellectual property as a trader. This brings us to the concept of platform independence, a strategic necessity that separates the amateurs from the professionals. When you use a broker's proprietary web trader, you are building your house on rented land. You might spend hundreds of hours customizing your workspace, setting up your trend lines, saving your favorite indicator templates, and getting comfortable with the button placement. You are investing your most valuable asset, time, into an ecosystem that you do not own. Imagine this scenario. You have been trading with Broker X for 2 years using their proprietary web platform. You have a dispute. Maybe they widen the spreads unfairly during a news event, or maybe they refuse to withdraw. You know you need to leave, but you realize with a sinking feeling that you cannot take your workspace with you. You cannot export your templates. You cannot transfer your custom indicators. You are starting from scratch. This vendor lock-in is intentional. It is designed to create a psychological barrier to exit. To avoid this trap, you must prioritize platforms that are broker neutral. The industry titans here are MetaTrader 4 MT4, MetaTrader 5 MT5, CTrader, and increasingly TradingView. These are third-party software solutions that license their technology to brokers. If you build your strategy on MetaTrader 4, and your broker starts acting shady, you can close your account, open a new one with a different broker, log in, and this is the magic part. Copy-paste your templates and indicators folder. Within 5 minutes, your entire business infrastructure is live on a completely new brokerage. You have achieved portability. You own your tools, the broker is merely the pipe. Let's dive deep into the MetaTrader 4 versus MetaTrader 5 debate. Because despite being 20 years old, MT4 still commands a massive market share. Why? It's not because it looks good. Frankly, the interface looks like it was built for Windows 95. It is clunky, gray, and uninspiring. But under the hood, it relies on MQL4, MetaQuotes Language 4. This programming language birthed the largest algorithmic trading community in the world. Even if you never plan to write a single line of code, this matters to you. Because of MQL4, there are tens of thousands of free and paid custom indicators and expert advisors, trading robots, available online. Do you want an indicator that automatically draws support and resistance zones based on Fibonacci levels? It exists. Do you want a tool that calculates your position size based on your stop-loss distance and account equity automatically? You can download it and drop it into your folder. On a proprietary web platform, you are stuck with whatever basic tools the broker gives you. On MT4, the community builds the tools the brokers forgot. However, MT4 has limitations. It is a 32-bit, single-threaded application. This means if you try to backtest a complex strategy over 10 years of data, it might take hours. It can crash if you load too many charts. Enter MetaTrader 5. MT5 is the 64-bit, multi-threaded evolution. It is a beast for backtesting. Let's look at a specific use case for the algorithmic trader. In MT5, you can use the strategy tester to run multi-currency backtests. You can test a strategy that buys euro to US dollar only when the S&P 500 is rising. MT4 cannot do this natively because it treats each chart as an isolated island. MT5 also offers depth of market (DOM) integration, allowing you to see the volume of orders at different price levels, a feature critical for scalpers reading order flow. If you are a discretionary trader who just looks at charts, MT4 is fine. If you are a data-driven quant or you want to test strategies rigorously, MT5 is the superior engine. Then we have CTrader. If MetaTrader is the rugged, reliable diesel truck, CTrader is the sleek electric sports car. It was built from the ground up for ECN electronic communication network trading. Visually, it is stunning. It has fluid charts, intuitive hotkeys, and a modern interface that doesn't make your eyes bleed. But the real value is in its transparency. CTrader has a feature called Trade Receipt, or Deal Map. When you execute a trade, CTrader can show you the exact timestamp of execution down to the millisecond, the slippage incurred, and often a breakdown of how the order was filled. It is designed for traders who demand to know exactly what happened to their order. Furthermore, CTrader's coding language is C#, C#. This is a widely used, standard programming language, unlike MQL, which is proprietary to MetaQuotes. This makes it much easier for professional developers to build complex algorithms on CTrader. If you are looking for a platform that feels like it belongs in the 21st century and prioritizes ECN transparency, CTrader is often the top pick. Now we must address the elephant in the room: TradingView. Over the last 5 years, TradingView has become the gold standard for charting. Its HTML5 charts are beautiful, fast, and accessible from any browser without installation. The social aspect, sharing ideas, seeing other people's analysis, is unmatched. But here is the critical distinction: charting is not executing. For years, traders would analyze on TradingView, then alt-tab to MT4 to place the trade. This creates friction. It introduces a data feed discrepancy. The price you see on TradingView, which might be coming from a generic feed like FXCM or IDC, might be slightly different from the price on your broker's MT4 terminal. You might see a support level hit on TradingView, but your broker's price hasn't touched it yet. You click buy and you enter at a bad price. Recently, many brokers have integrated directly with TradingView. This allows you to connect your brokerage account to the TradingView interface and execute trades directly from the charts you are analyzing. This is the holy grail for many. However, you must verify the server-side execution. When you click buy on TradingView, the signal is sent to TradingView's server, then to the broker's API, then to the market. While this is fast, it adds an extra hop compared to a direct MT4 connection. For swing traders, this is irrelevant. For high-frequency scalpers, that extra millisecond could be the difference between profit and loss. Let's talk about the intellectual property aspect of your trading history. This is something almost no beginner considers until they face an audit or try to raise capital. If you want to eventually trade for a prop firm or manage investor money, you need a track record. You need a verified history of your performance. Proprietary platforms often have terrible export features. They might only let you download a PDF statement for the last 3 months. If you switch brokers, you lose that history. MetaTrader, however, generates detailed HTML reports that are the industry standard. Furthermore, you can link your MT4/MT5 investor password to third-party auditing sites like MIFSbook or FXBlue. These sites pull your data directly from the server, verifying your performance. You can't fake it. This verified track record is your resume. If you are on a platform that doesn't support third-party auditing, you are trading in the dark. You are building a career with no proof of your competence. Imagine trying to get a loan to buy a house, but your bank says, "We don't accept statements from that specific weird bank you used." That is what it's like trying to show a proprietary platform statement to an investor. Finally, we need to discuss VPS hosting compatibility. A virtual private server is a computer that runs in the cloud 24/7. If you use trailing stops or automated trading bots, EAs, you cannot rely on your home laptop and your home Wi-Fi. If your internet cuts out for 2 minutes while you have an open trade managed by a bot, and the market crashes, the bot cannot close the trade. You are exposed. Standard platforms like MT4 and CTrader are designed to be lightweight and run easily on a VPS. You can rent a slice of a server in New York, install MT4, load your bot and disconnect. It runs forever. Many proprietary web platforms do not have a desktop application that can be installed on a VPS. They require an active browser session. If the browser closes, the platform logs out. This makes professional, automated risk management impossible. We have covered the engine execution, the safety gear regulation, and the cockpit software. But even the best pilot in the best plane will eventually run into turbulence that they cannot solve alone. The engine might sputter. The landing gear might jam. In the world of Forex, this manifests as a frozen platform during a news spike, a withdrawal that vanishes into the banking ether, or a trade that inexplicably closes itself. When that happens, you are at the mercy of one department: customer support. And I don't mean the friendly chatbot that asks, "How are you today?" I mean the crisis management team. Most traders think good support is a fast reply. Real traders know that good support is a dealing desk that answers the phone at 3 a.m. when you are screaming that your hedge didn't execute. In the next part, we are going to audit customer service in a way you never have before. I will give you a stress test script, a set of specific technical questions to ask a broker's support team before you deposit a single dollar. Their answers will reveal if they are trained professionals or just minimum wage sales agents reading from a script. We will also discuss the nightmare of withdrawal friction and the documents you need to have ready to ensure they can never hold your money hostage. This is the insurance policy you hope you never need but cannot survive without. You are alone in the dark. It is 3:14 a.m. The market has just crashed 200 pips on rumors of a central bank intervention. Your platform is frozen. You have a massive position open that was in profit, but now you have no idea if you are rich or bankrupt. You frantically click the live chat button. A little bubble pops up. You are number 47 in the queue. This is the exact moment you realize that customer support is not a courtesy. It is a lifeline. And most traders do not test the strength of that rope until they are already hanging from it. We are going to conduct a forensic audit of a broker's support infrastructure. Do not wait until you have a crisis to do this. You need to perform the stress test before you even create a login. Here is the brutal reality. Sales teams are paid to be fast. Support teams are often paid to be cheap. If you get a reply in 10 seconds when you ask, "How do I deposit?" but you get silence when you ask, "Where is my withdrawal?" you are dealing with a firm that prioritizes acquisition over retention. Here is your specific stress test script. Open the live chat window. Do not ask, "Is your support good?" That is a useless question. Instead, ask a specific, technical question that requires a non-scripted answer. Ask them, "Can you please provide the link to your order execution policy PDF? And specifically, do you apply asymmetric slippage on limit orders?" Watch the response time. Watch the quality. A low-tier support agent will have no idea what you are talking about. They will copy-paste a generic FAQ about what is Forex, or they will transfer you to a manager who never connects. A professional support agent at a top-tier broker will either link you the document immediately or give you a knowledgeable answer about their liquidity providers. This tests the competence of the staff. If the frontline staff does not understand basic market mechanics, they cannot help you when the mechanics break. Next, perform the time zone audit. Forex is a 24-hour market. Your support needs to match your trading hours. If you are in California trading the Asian session, Tokyo Open, but your broker is based in London and their support goes offline at 5 p.m. UK time, you are trading without a net. You need 24/5 support minimum. 24/7 is better, covering the crypto markets on weekends. Test this. Log on at a weird hour midnight on a Tuesday and see if a human answers. If you get a leave a message bot, that broker is not suitable for serious overnight trading. Now we need to talk about the emergency dealing desk phone number. This is a feature that almost nobody asks about, but it is the ultimate failsafe. In the event of a catastrophic internet failure, either yours or the broker's servers, you need the ability to call a phone number, verify your identity with a voice password, and say, "Close all positions at market." Many modern app-based brokers do not have a dealing desk you can call. If the app is down, you are stuck. Look for brokers that openly list a trading desk or emergency orders phone line. Write that number down and stick it to your monitor. It is the fire extinguisher. You hope you never use it, but if the kitchen catches fire, you don't want to be searching Google for the fire department's number. Let's shift gears to the most painful part of the trading experience. Withdrawal friction. You have made the profit. The numbers are on the screen. But until that money hits your bank account, it is just pixels. It is not real. Unethical brokers use a tactic called the churn. They know that if they delay your withdrawal for 48 hours, there is a statistically high probability that you will get impatient, cancel the withdrawal, and gamble it back into the market. They add friction to the exit to keep your liquidity in their pool. The most common weapon of mass friction is the KYC loop. Know your customer laws are real, and brokers must follow them. However, shady brokers weaponize them. You upload your passport. They wait 3 days, then reject it because the corner was slightly cut off. You re-upload. They wait another 3 days, then reject your utility bill because it is not a PDF. Suddenly, 2 weeks have passed, and you still haven't been paid. To defeat the KYC loop, you must be aggressive. Before you deposit a single cent, go to the verification section. Upload your documents. Ensure your ID is high resolution, with all 4 corners visible, no glare and clearly legible. Ensure your proof of address is a utility bill or bank statement dated within the last 90 days. This is a strict industry standard. If they reject it, demand a specific reason immediately. Do not fund the account until the status says verified. If they let you deposit without verification but demand verification to withdraw, that is a trap. That is the Roach Motel model. You can check in but you can't check out. Another layer of friction is the source of funds rule, often tied to anti-money laundering, AML, regulations. This rule states that you must withdraw funds back to the exact same source you used to deposit, up to the amount of the deposit. If you deposited $1,000 via Visa card, you cannot withdraw that $1,000 to your Bitcoin wallet or your bank wire. You must refund the card first. Only the profit can be withdrawn to a different method, and even then restrictions apply. Imagine this scenario. You deposit $5,000 using a credit card to get points. You trade well and double the account to $10,000. You want to withdraw everything. The broker will likely refund $5,000 to your credit card, which might take 3 to 5 business days to appear as a statement credit, and then require a separate bank wire for the $5,000 profit. If the card you used has expired or was canceled in the meantime, you enter a bureaucratic hell where you have to get a letter from the bank proving the card is closed before they will release funds elsewhere. Understanding this return-to-source hierarchy prevents panic when your withdrawal options look limited in the portal. Then there is the bonus trap. We touched on this briefly, but let's detail the mechanics because it destroys thousands of accounts every year. You see a banner. 100% welcome bonus. Deposit $1,000, get $1,000 free. Sounds like free money. It is actually a pair of golden handcuffs. When you accept a bonus, you are agreeing to terms and conditions that usually include a volume requirement. A typical requirement is standard lots equals bonus amount /5. So, for a $1,000 bonus, you might need to trade 200 standard lots before you can withdraw any of your money, not just the bonus but your own deposit too. 200 lots is $20 million worth of currency volume. A retail trader with a $2,000 account trying to trade that volume will almost certainly blow up their account due to over-leveraging before they unlock the withdrawal. Never, ever accept a deposit bonus unless you are a high-volume scalper who has done the math and knows you can clear the volume hurdle. For 99% of traders, tick the box that says, I decline the bonus. You want your capital to be liquid, not locked. Finally, we must compare the speed and cost of the rails themselves. How does the broker move money? Bank wires are the standard for large sums. They are secure, but they are slow, 2 to 5 business days, and expensive, $25 to $50 fees. If you are moving 5 figures or more, use wires. Credit/debit cards are instant for deposits, which is great for topping up to avoid a margin call, but withdrawals can be slow depending on the card issuer. E-wallets, Skrill, Neteller, PayPal, and crypto USDT/Bitcoin are the speed kings. Withdrawals can often be processed in hours or even minutes. However, look for hidden conversion fees. If your account is in USD, but you deposit via Euro bank account, the broker or their payment processor will exchange your money at a terrible rate. You might lose 3% of your capital just on the deposit. Always open your trading account in the currency of your funding source if possible, or use a multi-currency bank account like Revolut or Wise to handle the conversion yourself at the mid-market rate before sending it to the broker. We have secured the perimeter, audited the support, and cleared the exit routes. Now we need to look at the structure of the account itself. You might think an account is an account, but brokers segregate traders into different tiers. There is the standard account for the masses, the raw account for the scalpers, and the hidden VIP, or institutional tiers that they don't advertise on the homepage. In the next part of this masterclass, we are going to decode the account type matrix. I am going to explain why the standard account is almost always a mathematical ripoff designed for losers, and why you should almost always pay commission to get the raw spreads. We will also discuss how to negotiate with a broker. Yes, you can negotiate. If you have volume, you can get lower commissions, free VPS hosting, and even rebates. I will teach you what to say to get the pro deal that is usually reserved for hedge funds. This is how you level the playing field. Let's rip the bandage off the standard account. If you are trading on a standard, classic, or micro account type where the broker boasts 0 commissions, you are voluntarily paying a tax on your own ignorance. The industry is designed to funnel new traders into these accounts because they are mathematically the most profitable for the broker and the most detrimental to the trader. Here is the raw mathematics that the marketing brochures conveniently omit. In a standard account, the broker generates revenue by marking up the spread. On euro to US dollar, the raw interbank spread might be 0.1 pips. The broker marks this up to 1.5 pips. They pocket the 1.4 pip difference. Now 1.4 pips equals $14 per standard lot. You pay this every single time you open a trade, regardless of whether you win or lose. Now compare this to the raw, razor, or ECN account type. Here the broker gives you the raw market spread, let's say 0.1 pips, and charges a fixed commission. The industry standard is roughly $7 per round turn, opening and closing. Let's run the imagine if scenario over a full trading year. Imagine you are an active day trader executing 5 standard lots a day. That is roughly 100 lots a month or 1,200 lots a year. In the standard account, you are paying 1.4 pips per lot. That is $14 times 1,200 lots. Your total cost of doing business is $16,800. In the raw account, you are paying 0.1 pips spread $1 plus $7 commission. Total cost is $8 per lot. $8 times 1,200 lots is $9,600. By simply clicking a different button during the sign-up process, you save $7,200 a year. That is the price of a used car. That is a luxury vacation. Or, more relevantly, that is a 72% return on a $10,000 account that you just threw away because you were afraid of the word commission. The standard account is a trap. Unless you are trading nanolots pennies per point, where the minimum commission fee would be disproportionately high, you must always, without exception, choose the commission-based account. But here is the secret that is usually reserved for institutional desks. The commission rate is not fixed. It is a starting point for negotiation. Most retail traders view a broker like a utility company. You pay the rate they set. Professional traders view a broker like a business partner. Everything is negotiable if you have leverage. And in this industry, leverage is volume. If you are trading respectable volume, usually defined as more than 50 standard lots per month, you have the power to demand a better deal. Brokers are terrified of churn, which is the metric of clients leaving for a competitor. Acquiring a new client costs them hundreds of dollars in marketing. Keeping an existing high-volume client happy is cheap. Here is the exact script you should use. Send an email to your account manager. Do not use the general support email. Find the specific person assigned to you. Subject line: Commission Review Volume Tier. Write this: I am currently reviewing my brokerage setup for the coming quarter. I am averaging lots per month. Competitor is offering me a commission rate of $5.50 per round turn. I prefer your platform's execution, but the cost difference is becoming significant. Can you match this rate or move me to an active trader tier? 9 times out of 10, if your volume backs up your claim, they will slash your commissions. They have discretionary authority to lower fees to keep a runner. I have seen traders cut their operational costs by 30% just by sending one email. If you never ask, the answer is always no. Furthermore, you need to investigate cashback rebates. This is an entire sub-industry that exists in the shadows. When you sign up for a broker through a link on a website, that website is often an introducing broker, IB. The broker pays the IB a kickback for every trade you place. Sometimes the IB gets $5 per lot from the commission you paid. Smart traders sign up through rebate providers or cashback services. These services act as the IB, but they split the kickback with you. They might keep $2 and give you $3 back. It is deposited directly into your trading account or sent to your PayPal every month. Think about the compound effect of this. If you are breaking even on your trading strategy, making zero profit from the market, but you are getting paid a $3 rebate on every lot, you effectively turn a break-even strategy into a profitable business. There are algorithmic traders who run strategies that intentionally break even just to farm the rebate checks. This is how you turn the casino's edge against them. However, we must address a specific nuance for certain traders: the Islamic or swap-free account. Under Sharia law, earning or paying interest, riba, is prohibited. Since the swap in Forex is an interest rate differential, observant Muslim traders cannot pay or receive it. Brokers offer swap-free accounts to accommodate this. But be warned, brokers are not charities. If they remove the swap revenue, they replace it elsewhere. Usually, this comes in the form of administration fees or significantly wider spreads. Some brokers allow you to hold a trade swap-free for 5 to 7 days, but on day 8, a flat fee kicks in that is often double the cost of a normal swap. If you are not Muslim, do not try to game the system by opening an Islamic account to avoid negative swaps. The admin fees will likely bleed you faster than the interest rates would have. Read the fine print on the grace period carefully. Now let's zoom out and look at the asset class coverage. We have focused heavily on Forex, but modern markets are interconnected. You might be a euro to US dollar trader, but what happens when the S&P 500 crashes? The euro often moves in correlation. To trade effectively, you often need to see what other markets are doing. A top-tier platform should not just offer currency pairs. It should offer multi-asset connectivity. You want to be able to overlay the chart of gold XAU/USD, oil WTI, and the US 10-year Treasury yield onto your Forex charts. Here is a case study of why this matters. In 2022, the correlation between the US dollar and the 10-year Treasury yield was incredibly high. If yields went up, the dollar went up. A trader looking only at the euro to US dollar chart was seeing half the picture. A trader who had the US 10-Y chart overlaid on their screen saw the breakout in yields 5 minutes before the selling hit the euro. They had a leading indicator. Many budget brokers offer CFDs, contracts for difference, on indices and commodities, but they are often terrible products with massive spreads. You want to check the contract specification for these non-Forex assets. If the spread on the S&P 500, often listed as SPX 500 or US 500, is 5 points wide, it is untradeable for intraday moves. A competitive spread is 0.4 or 0.5 points. If your broker restricts you to only 20 currency pairs and nothing else, you are trading in a silo. You are blind to the macro forces, oil, bonds, equities that are actually driving the currency flows. The best platforms are one-stop shops, where you can hedge your Forex exposure by shorting the S&P 500 in the same terminal, using the same margin pool. This is called cross-margining. Imagine you are long euro to US dollar and the market turns against you because of a risk-off event, war, pandemic scare. Instead of closing the trade and realizing the loss, you could short the DAX, German stock index, in the same account. Since the DAX often falls when the euro falls in risk-off scenarios, your profit on the DAX hedge offsets your loss on the euro. You stabilize your equity curve, but you can only do this if your broker offers a wide range of liquid, low-spread CFDs and recognizes the margin offset. We have optimized the cost, the account structure, and the asset list. But there is still one massive barrier between you and the smart money. The banks and hedge funds are not looking at the same data you are. You are looking at a candlestick chart, a record of where price was. They are looking at the order book, a map of where price is going. Most retail platforms give you level 1 data. This is the bid and the ask. That's it. Institutional terminals use level 2 data or depth of market, DOM. They can see that there are $50 million worth of sell orders sitting at 1.0550. You can't see that. You just see a resistance line. They see the concrete wall. In the next part of this deep dive, we are going to explore the information war. I am going to show you how to find platforms that offer true depth of market for retail traders. We will discuss the difference between tick volume, which is often fake, and real volume. And I will introduce you to the concept of sentiment analysis, using the broker's own client data to bet against the crowd. When 80% of retail traders are long, you want to be short. I will show you exactly where to find that contrarian signal. This is how you stop being the liquidity and start being the predator. Welcome to the information war. In financial markets, data is ammunition, and if you are looking at a standard candlestick chart while the institutions are looking at the order book, you are bringing a knife to a gunfight. The most critical, yet frequently overlooked feature in a professional trading platform is access to level 2 data, also known as depth of market or DOM. Most retail platforms provide what we call level 1 data. This is simply the best available bid and the best available ask. It is the tip of the iceberg. It tells you the current price, but it does not tell you the conviction behind that price. It hides the battlefield. Imagine this scenario. You are looking at a resistance level on euro to US dollar at 1.0850. The price is approaching it. On your standard chart, it looks like a simple line. You have no idea if there is a concrete wall of sellers there or a paper-thin barrier. You buy the breakout. The price touches 1.0850 and instantly collapses 50 pips. You are stopped out. You think it was bad luck. Now, look at that same scenario through the lens of a platform equipped with depth of market. As the price approaches 1.0850, you look at the ladder. You can see not just the current price, but the pending limit orders sitting at prices above the market. You see that at 1.0850, there are institutional sell orders totaling 50 million units. At 1.0851, there are another 20 million. This is a fortress. With this information, you would never have bought that breakout. You would have seen the wall. You might have even front-run the institutions and placed a sell order at 1.0849, writing the rejection down with the smart money. This is the difference between guessing and knowing. When comparing platforms, specifically ask, do you offer level 2 market depth via fixed API or directly in the terminal? If they say, what is that? You are dealing with a broker designed for amateurs. Note that in Forex, because there is no central exchange, the DOM is aggregated from the broker's specific liquidity providers. Therefore, a broker with more Tier 1 liquidity providers, banks like JP Morgan, UBS, XTX, will have a thicker, more accurate DOM than a small broker. However, we must distinguish between real volume and tick volume. In the stock market, volume is transparent. You know exactly how many shares of Apple were traded today. In Forex, the market is decentralized. There is no central ledger. Consequently, the volume histogram you see at the bottom of your MetaTrader 4 chart is actually tick volume. Tick volume measures how many times the price changed up or down during that candle. The theory is that price changes require activity, so high tick counts equal high volume. Historically, the correlation is about 90%. But in the age of high-frequency trading, HFT, this correlation can break down. Algorithms can paint thousands of price updates with very little actual money changing hands to create the illusion of activity, a technique known as painting the tape. Advanced platforms offer real volume, overlays by aggregating data from major futures markets, like the Chicago Mercantile Exchange's Euro futures, or by purchasing data feeds from wholesale ECNs. If a platform offers futures volume integration, it is a massive value add. It allows you to see where the actual money is changing hands, not just where the algorithms are twitching. This leads us to the most powerful weapon in the retail trader's arsenal, a feature that turns your greatest weakness into your greatest strength: sentiment analysis. We know that statistically, the vast majority of retail traders lose money over the long term. This is not a judgment, it is a data point. Therefore, if we know that the herd is usually wrong at major turning points, we can use the herd's positioning as a contrarian indicator. If 80% of retail traders are buying gold, it is highly probable that gold is about to crash. Why? Because if 80% of the market is already long, who is left to buy? The buyers are exhausted. Furthermore, that cluster of long positions represents a massive pool of stop-loss orders sitting just below the current price. Institutions see this. They know that if they can push the price down just a little bit, they will trigger a cascade of sell orders stops that will provide them with the liquidity they need to fill their own massive buy orders at a lower price. Top-tier platforms integrate client sentiment widgets directly into the dashboard. You want to look for a long/short ratio indicator. Let's look at a historical case study. In many significant market reversals, specifically in the pound sterling to US dollar post-Brexit volatility, retail sentiment hit extreme levels, often exceeding 90% long positioning, while the price continued to make lower lows. The retail crowd was trying to catch the falling knife, averaging down into a losing trade. A trader with access to sentiment data would see this 90% figure and immediately know, do not buy. The washout hasn't happened yet. They would wait until the sentiment shifts or the price capitulates. When evaluating a platform, check if their sentiment data is updated in real time or if it is a daily snapshot. Real time is superior. Also check the sample size. A broker with 5,000 clients cannot give you accurate market sentiment. A major global broker with 500,000 clients provides a statistically significant sample of the global retail mood. Now we must integrate the news feed and economic calendar. Every platform has a calendar. Most of them are useless. A standard calendar tells you CPI is at 8:30. That is static data. In the modern market, you need dynamic news infrastructure. You need to look for platforms that integrate audio squawk. A squawk service is a live audio feed where a human analyst at a trading desk in London or New York reads the headlines the second they hit the terminal. Imagine you are in a trade. Suddenly, the price spikes 20 pips. You are confused. You check your text-based news feed. Nothing there. You check Twitter. Nothing yet. By the time you realize that a central banker just made a surprise comment about raising rates, the move is over. Now imagine you have a squawk feed active. You hear a voice in your ear. ECB President Lagarde mentions inflation concerns. Euro spiking. You hear the reason as the candle is forming. You can react instantly. either cutting a losing trade or pyramiding into a winner. Some premium platforms include a subscription to services like Financial Juice or Randsquawk for free. This value alone can be worth $50 to $100 a month. If a broker offers a premium news feed from Bloomberg or Reuters, not just a generic RSS feed, it shows they cater to fundamental traders, not just technical gamblers. We also need to discuss automated pattern recognition. For the trader who cannot stare at the screen 12 hours a day, tools like AutoChartist or Trading Central are invaluable features to look for. These are third-party plugins that scan thousands of instruments 24/7. They look for triangles, wedges, head and shoulders, and support/resistance breakouts. When a pattern is identified, the platform sends you an alert. Euro to Japanese yen approaching resistance channel top. Do not mistake this for a signal service. You should never blindly follow these alerts. However, they act as a highly efficient filter. Instead of manually scanning 50 charts, the software hands you a short list of 5 charts where something interesting is happening. You then apply your own analysis. If a broker offers these premium plugins for free to clients with funded accounts, it is a significant checkmark in the pros column. It reduces your workload and ensures you don't miss obvious setups because you were getting coffee. Finally, in the realm of information, we must check for correlation matrices. We briefly touched on multi-asset analysis, but a correlation matrix is a specific tool that calculates the mathematical relationship between pairs in real time. If you are long euro to US dollar and long pound sterling to US dollar, and short US dollar to Swiss franc, you might think you have 3 diversified trades. A correlation matrix will show you that these 3 trades are 95% correlated. You effectively have one giant position on short USD. If the dollar rallies, you lose on all 3 trades simultaneously. You have tripled your risk, not diversified it. A professional platform will allow you to pull up a grid showing the correlation coefficients, from -1 to +1, of your open positions. It acts as a risk management sanity check. Before you place a trade, you check the matrix. If the new trade has a +0.9 correlation with an existing position, you know you are just adding to the same bet. If it has a -0.8 correlation, you are effectively hedging. Platforms that hide this data want you to over-leverage. Platforms that visualize this data want you to survive. We have armored you with data. You can see the order book, you can hear the news, and you can feel the sentiment of the herd. But the modern world is not static. You are not always sitting at your desk with 3 monitors and a fiber optic connection. Sometimes you are on the train. Sometimes you are at dinner. And the market starts to move. This brings us to the mobile app experience. Most traders treat the mobile app as an afterthought, a tool just to check balance. This is a fatal error. In an emergency, your phone is your backup generator. But not all mobile apps are created equal. Some are stripped-down toys. Others are fully functional cockpits. In the next part, we are going to conduct a brutal user experience audit of the mobile trading landscape. We will expose the dangerous limitations of one-click trading. On mobile screens, fat finger errors are real. I will show you why biometric security is a non-negotiable feature for your phone, and we will discuss the sync problem, why drawing a trend line on your phone often fails to appear on your desktop, and how that disconnect can cost you thousands. We are going to find out if you can actually run a business from your pocket, or if you are just gambling on the go. Let's be brutally honest about mobile trading. Most brokerage advertisements show a handsome guy in a bespoke suit, sipping espresso in a cafe, tapping his phone, and making thousands of dollars. This is a fantasy. In the real world, trading from your phone is often an act of desperation or reckless convenience. Professional traders do not analyze complex market structures on a 6-inch screen. They use the mobile app for one primary purpose: monitoring and management. It is a remote control for your business, not the factory floor. The first and most catastrophic failure point in the mobile ecosystem is the sync gap. This is a technical flaw that exists in the architecture of legacy platforms like MetaTrader 4. When you draw a trend line, a Fibonacci retracement, or mark a supply zone on your desktop terminal, that data is often stored locally on your computer's hard drive, specifically in the Profiles folder. It is not always stored on the broker's server. Here is the imagine if nightmare scenario. You spend Sunday night doing your analysis on your desktop. You mark a critical weekly resistance level on euro to US dollar at 1.0950. You decide that if price hits this line, you will short the market. You draw a thick red line on your chart. Monday morning comes. You are on the train to work. You open your mobile app. The price is rallying hard. It looks like a massive breakout. You feel the FOMO, fear of missing out. You check the chart on your phone. It looks clear. There is no red line. Why? Because the line you drew on your desktop didn't sync to your phone. Without that visual anchor, you forget the weekly context. You see a bullish candle and you buy, thinking it's a breakout. 5 minutes later, price slams into the 1.0950 resistance level. The one you marked at home but couldn't see on your phone, and reverses. You are trapped in a losing trade because your data was fragmented. When comparing platforms, you must test for cloud-based charting sync. Modern platforms like TradingView and CTrader utilize server-side drawing storage. If you draw a line on your laptop, it instantly appears on your iPad and your Android phone. It is a unified workspace. If a broker's proprietary app does not offer this seamless continuity, you are effectively trading with two different brains that aren't talking to each other. Next, we have to audit the one-click trading feature on mobile. On a desktop, one-click trading is a powerful tool for scalpers. On a mobile device, it is a loaded gun with a hair trigger. Mobile interfaces are touch-sensitive. You scroll with your thumb. The buy and sell buttons often float over the chart or sit dangerously close to the timeframe selector. Consider this common occurrence. You are scrolling back through the chart history to see previous price action. Your thumb slips. You accidentally tap the buy button. Because you enabled one-click trading to be faster, there is no confirmation pop-up. The order is sent instantly. You are now long 5 standard lots of gold while you are walking down the street. Worst of all, you might not even realize you opened the trade until you see your equity fluctuating. By the time you close it, you've paid the spread and potentially a loss. To protect yourself, you must look for apps that offer biometric execution confirmation. This is a safety feature where, even with one-click trading enabled, the app requires a split-second Face ID or Touch ID scan to confirm the order. It adds almost zero latency, but prevents 100% of accidental pocket trades. If the app doesn't have this, disable one-click trading on mobile immediately. The risk of a fat finger error outweighs the benefit of speed. We also need to talk about visual tunnel vision. Mobile screens force you to zoom in. You lose the peripheral vision of the market. On a desktop, you can have the 1-hour chart, the 4-hour chart, and the daily chart open side by side. You can see the trend within the trend. On mobile, you are usually looking at one time frame in isolation. Psychologically, this makes price moves look more dramatic than they are. A 10-pip drop on a zoomed-in 5-minute mobile chart looks like a market crash. It triggers an emotional response. You panic sell. If you had looked at the desktop, you would have seen that the 10-pip drop was just a minor pullback to a moving average. The form factor of the device actually degrades your decision-making quality. To combat this, evaluate the app's multi-chart layout capabilities. Some advanced mobile apps on tablets or large phones allow you to split the screen and view 2 charts simultaneously. Or they offer a quick-switch toolbar that lets you toggle timeframes without opening a menu. If changing timeframes takes 3 taps, you won't do it enough. You want an app where checking the higher timeframe is frictionless. Let's move to notification hygiene. A good trading app should be your personal sentry, alerting you to danger. A bad trading app is a spam machine. Many broker apps default to sending you market updates, promo offers, and volatile mover alerts every hour. This creates alert fatigue. When your phone buzzes, you ignore it because you assume it's just marketing noise. Then the real alert comes, margin call warning, and you ignore that too. You need to look for granular alert management. Can you turn off marketing push notifications while keeping price level alerts and order execution alerts on with a specific sound? The best apps allow you to set server-side alerts. This means if you set an alert for gold crossing $2,000, the alert lives on the broker's server, not your phone. Even if your phone is off or in airplane mode, the server will send an email or SMS. If the alert relies on your app being open in the background, it is unreliable. Battery optimization features on modern phones often kill background apps, silencing your alarms. Now, consider the Internet Connectivity Protocol. What happens when you go into a tunnel? You are managing a trade. You have a stop loss at 1.0500. You want to move it to break even. You tap Modify Order. The train enters a tunnel. The signal drops to 1 bar. The app spins. Does the app queue the modification and send it when the signal returns? Or does it time out and fail silently? A robust mobile trading app will have a clear connection status indicator, usually a color .green/red, with the ping time in milliseconds visibly displayed. If the app hides the connection status, you are flying blind. You might be looking at a price quote that is 30 seconds old, thinking it is live. You try to trade on that stale price, and you get hit with a requote or massive slippage when the connection reconnects. We must also scrutinize the available order types on mobile. It is shocking, but many mobile versions of trading platforms are light versions. They might allow you to place market orders and simple stop losses, but they strip out the advanced orders. Can you place a buy stop limit order on your phone? Can you set a trailing stop from the mobile interface? Here is a crucial technical detail. On MetaTrader 4, trailing stops are client-side. This means your computer must be on and the platform running for the trailing stop to work. If you set a trailing stop on your desktop and then turn your computer off, the stop stops trailing. It becomes a fixed stop loss at the last moved price. Many mobile apps do not allow you to set trailing stops because the phone cannot guarantee 100% uptime. However, cloud-native platforms like CTrader handle trailing stops on the server. You can set it on your phone, turn the phone off, and the server continues to manage the trail. This is a massive advantage for mobile risk management. Finally, let's address the security of funds on the device itself. Your phone is the most easily stolen item you own. If a thief snatches your unlocked phone while you are using it, they have access to your email, your 2FA codes, and your trading app. Does the app have an auto-lock timer? Can you configure it to require a PIN or Face ID every time the app is brought to the foreground, even if the phone itself is unlocked? And critically, does the app mask your account balance on the dashboard? You don't want to be opening your app in a public place and flashing a $50,000 balance to the person standing behind you. Look for a privacy mode or hide balance toggle. It's a small feature that shows the developers understand the real-world environment of mobile trading. We have dissected the platform from the deepest server mechanics to the glass screen in your pocket. You now have a checklist of features that goes far beyond low spreads. You know to look for server-side trailing stops, execution transparency, data portability, and regulatory safety nets. But there is one final variable we have not discussed. It is the most volatile variable of all. It is not the market. It is not the broker. It is you. You can have the best platform in the world, a Tier 1 regulated, ECN execution, zero latency institution-grade setup. But if you do not understand the psychology of the interface, the platform itself can trick you into gambling. The colors, the flashing lights, the sounds, they are all designed to trigger dopamine. In the final part of this masterclass, we are going to synthesize everything into a final decision matrix. I am going to give you a weighted scorecard to grade your current broker, and we will expose the subtle gamification tactics that brokers use to turn their platforms into video games, encouraging you to overtrade. We will teach you how to strip your platform down to a boring, silent, money-making utility. This is the conclusion where we turn the technology off and turn the business mind on. Let's look at your screen. Really look at it. Does it look like a professional workspace? Or does it look like a video game? This is the final, most uncomfortable truth about the brokerage industry. Many modern platforms are engineered using the exact same psychological principles as slot machines. They are designed to trigger dopamine loops. They want you to trade. They need you to churn. And they use gamification to bypass your logical brain and tap directly into your impulse centers. Consider the visual language of a default trading terminal. When price ticks up, it flashes bright neon green. When it ticks down, it flashes aggressive red. Why? Because these colors are evolutionary triggers. Red signals danger, blood, urgency. Green signals safety, food, go. When you are staring at a 1-minute chart that is strobing red and green like a disco floor, your amygdala, the primitive fight or flight part of your brain, is constantly firing. You are in a state of physiological arousal. Your heart rate elevates. Your palms sweat. In this state, you are biologically incapable of making rational, long-term statistical decisions. You are reacting, not responding. Imagine this scenario. You are in a losing trade. The screen is flashing red. The P&L, profit and loss number is ticking down in real time, bold and large, -$50, -$60, -$70. The visual urgency creates pain. You want the pain to stop. So, you close the trade prematurely just to make the red flashing stop. Or conversely, you see a flash of green. Plus $10. You feel a hit of pleasure. You grab the profit instantly, afraid it will disappear. You just cut a winner short because the interface made you emotional. To professionalize your operation, you must degamify your environment. This is a step-by-step exorcism of the casino elements. First, neutralize the color palette. Go into your chart settings right now. Change your bullish candles to white or light gray. Change your bearish candles to black or dark gray. Remove the background grid. Make the background a neutral dark gray or soft blue. By removing the red/green stimulus, you strip the emotion from the price action. A drop in price becomes just data, not a bloody wound. Traders who switch to monochrome charts often report an immediate decrease in anxiety and a measurable improvement in their ability to hold trades to their targets. Second, hide the floating P&L. Most platforms display your floating profit or loss in big, bright numbers right at the top of the screen. This is a distraction. It forces you to think in terms of money, not in terms of points or percentage. If you are watching the dollar amount fluctuate, you are trading your P&L, not the chart structure. You are worried about paying for dinner, not about whether the support level is holding. Professional platforms allow you to hide the P&L column or switch it to points/pips. Do this. Only look at the money when the trade is closed. While the trade is open, the only thing that matters is the technical execution. Third, silence the platform. Many apps play a satisfying ka-ching or a ding sound when a take profit is hit. It sounds harmless, right? Wrong. It is Pavlovian conditioning. Trains your brain to seek that sound. You start taking subpar setups just because you are craving the auditory reward of the ding. Conversely, the harsh buzz of a stop loss creates a punishment signal that makes you afraid to pull the trigger next time. Turn all platform sounds off. Trading should be silent. It should be boring. If you need excitement, go skydiving. Do not pay the market for your entertainment. Now that we have sanitized the interface, we need to synthesize everything we have learned in this masterclass into a final decision matrix. You cannot find the perfect broker because it does not exist. You can only find the least imperfect broker for your specific style. To do this, I want you to use a weighted scorecard. Draw a grid. We will assign a total of 100 points. Category 1. Safety and regulation. Weight, 40 points. This is the heaviest weighting for a reason. If they steal your money, nothing else matters. Give 40 points if they are NFA/CFTC, US, or FCA, UK, regulated with segregated funds. Give 20 points if they are ASIC, Australia, or CISEC, Cyprus, regulated. Give 0 points if they are regulated in Vanuatu, Seychelles, or St. Vincent. If a broker scores low here, they fail the entire audit. Do not pass go. Category 2. Cost of execution. Weight, 30 points. Run the math we discussed in Part 3. Calculate the total cost to round turn. Spread plus commission. If the total cost on Euro to US dollar is under 0.8 pips, $8 per lot, give them 30 points. If it is between 0.8 and 1.2 pips, give them 20 points. If it is over 1.5 pips, give them 0 points. You are paying too much. Category 3. Data and technology. Weight, 20 points. Do they offer level 2 data, Dom? Is the server location transparent, New York 4/LD4? Do they offer raw tick data for backtesting? If they offer a true ECN feed with no dealing desk intervention, full points. Category 4. Support and banking. Weight, 10 points. Did they pass the 3 a.m. stress test? Do they offer instant withdrawals? Is the support technical or sales focused? Rate your current broker on this scorecard. If they score below a 70, you are driving a car with no brakes. It is time to switch. But how do you switch without disrupting your business? You execute a parallel migration. Never rage quit a broker. Close your account and transfer all your funds to a new one in a single day. That is a recipe for disaster. If the new broker has a technical issue or rejects your ID, you are left with zero liquidity and zero market access. Instead, open the new account and fund it with the minimum required deposit. Keep your old account active. For 2 weeks, run a shadow campaign. Every time you take a trade, split the risk. If you normally trade 1 lot, trade 0.5 lots on the old broker and 0.5 lots on the new broker. Record the data. Compare the entry prices. Did the new broker fill you faster? Compare the swap rates at rollover. Compare the slippage on the exit. You are effectively paying a small tuition to audit the new broker with real money. Only when the new broker has proven their stability and execution quality over a statistically significant number of trades do you initiate the capital shift. And when you do shift, test the exit door first. Before you move your full capital, do a test withdrawal of $100. Ensure the pipe works. Ensure there are no surprise fees. Once that money hits your bank account, then and only then do you move the rest of the fleet. We have covered a massive amount of ground. We have torn apart the legal disclaimers, exposed the spread betting traps, analyzed the server infrastructure, and rewired your psychological relationship with the screen. You now possess the knowledge that the brokerage industry actively tries to obscure. You know that zero commission is a lie. You know that leverage is a double-edged sword that must be respected, not maximized. You know that the pretty charts are often just a facade for a dealing desk casino. But I must leave you with one final, grounding thought. You can have the lowest latency connection in the world. You can have a direct fiber optic line to the NASDAQ. You can have a platform with zero spreads and negative commissions. You can have the most ergonomic, degamified, monochrome setup ever built. And you can still lose every single dollar you have. The platform is not the pilot. It is just the plane. A bad platform can crash a good trader, yes. That is why we did this deep dive, to ensure your plane doesn't have mechanical failure. But a great platform cannot fly itself. No amount of order flow data or sentiment widgets can replace the hard, lonely work of discipline, risk management, and emotional control. You are the edge. The software is just the mechanism by which you express that edge. Don't become obsessed with the tools to the point where you neglect the craft. I have seen traders make millions on a clunky 20-year-old interface because they understood the market. And I have seen traders blow up six-figure accounts on the most advanced, $25,000 a month institutional terminals because they lack discipline. Your goal is to find a platform that gets out of your way. You want a platform that is invisible. One that executes when you click, pays you when you withdraw, and stays silent when you are thinking. Once you have found that, stop looking for better features. Stop looking for the holy grail indicator. Lock the interface and turn your focus inward. The market is waiting. Your infrastructure is now solid. The rest is up to you. If you found value in this deep dive masterclass, if you learned something about the industry that you didn't know before, make sure you are subscribed to the channel. We don't just skim the surface here, we go deep. In our next series, we are going to leave the platform behind and step into the mind of the market itself. We are going to deconstruct institutional order flow and show you how to read the footprints of the whales who actually move the price. You have the tool. Now it's time to learn how to use it. I'll see you in the next video.